There's a coming tsunami in commercial real estate foreclosures and possibly bank failures as well. I'll show you the complex reasons why in simple terms. Stay tuned. Hey everybody, Greg Barron, professor of real estate. And today I'm going to talk to you about commercial real estate foreclosures, what's on the horizon, and probably why there's going to be some bank failures as well on the regional level. You've read a lot of articles about this. I have, and everything that we see right now points to the last quarter of 2024 and into 25 as to the reasons why. So where I live in the hill country of Texas, we've got these huge power lines. You know, everything's bigger in Texas, and these massive vultures sit up there in flocks waiting for some roadkill to happen below them. And collectively, they'll see it and they'll all come down at once and swoop down, and they will start to feed on their prey. Well, the same thing's happening in the commercial real estate industry. I'm going to show you a couple of articles here that are very similar, where these vultures are collecting dry powder right now, waiting for this coming time when there's going to be this massive amount of transitional commercial real estate that goes from performing to non-performing, and they won't be able to refinance, and that time is coming soon. Let me show you a couple of articles that are very consistent, where vulture funds are collecting money right now to swoop down as prey to collect something that's going to transitionally make their wealth increase over the next few years, and how possibly you could participate as well. So to kind of set the table to where we're going with this, it always starts with the Fed fund rate and inflation. But as of June, just out, as you'll see by this article, inflation has hit 3%. Pop the cork, everything's going to change. Or is it? So this just out from Forbes. Inflation hits 12-month low, 3% as prices unexpectedly drop in June. So some key facts: inflation was 3% in June, according to year-over-year changes in the Bureau of Labor Statistics Consumer Price Index metric. That's a long sentence. The best inflation mark since June of 2023, 3%. That's better than May's 3.3% headline. Well, basically what's happening here is the Fed is doing what he wants to do. His target rate is 2%. You know, we've talked a lot about that, but what has it really done to the lending market? Because so far, the chairman has not budged on his Fed fund rate. So just out from the Market Insider, distressed investors see exceptional bargains in troubled U.S. commercial real estate sector. Well, that's a big duh. But let's read on. It says, distressed investors are viewing the U.S. commercial real estate industry as a utopia of great deals after the COVID-19 pandemic. Work from home shift caused office values to plummet last year. Private equity firms are putting this sector in their crosshairs as they set aside 64% of dry powder earmarked for commercial property investment toward office buildings in North America, according to data compiled by Preqin, Bloomberg reported. And another one by Business Insider, just recently published. Investors have lined up over $250 billion to scoop up distressed commercial real estate as pain in this sector continues. So the question that we're asking ourselves is, we're all waiting on this rate reduction by the Fed. Hopefully now they say it's going to be September, maybe 25 basis points. But the question is it too little too late? And I say, yes, it is. I'm going to show you something in just a second as an example as to why all of these funds are ready, because even if the Fed pivots in September once and maybe twice in December, it's still not going to be enough to fundamentally allow this whole process to refinance. It's like kicking the can. You know, as a kid, did you ever kick a can down the street? I did. I kicked it all the way down the street, and a lot of times right into the gutter. So basically what's been happening since last year is these holders of commercial real estate have been kicking this can down the road doing a little modifications to their loan, hoping that the Fed would start to reduce rates in the first quarter and then the second quarter and again in the third and fourth quarter so that they could ultimately refinance their properties. Well, they haven't. So they've kicked the can, and now these real estate properties are being kicked into the gutter, and they're going to do one of two things. They're going to give the keys back, or they're going to have to come up with more equity to refinance with bank covenants that are going to be really, really restrictive to them in the future. So what I thought I'd do today is give you a very simple example on a smaller commercial property as to effectively where they were when they started and where they're going to be at the end of this year, and just why is it going to be such a tsunami of real estate foreclosures that's going to come on the market. So we're going to jump into Performa Plus, the software that we use for what we call financial modeling that does sensitivity analysis. And that's a big word for basically putting your data in and determining if it's a viable go or no go. You've heard me talk about this if you listen to the channel, but I've got this smaller project. Well, smaller is subjective. It's a $7 or $8 million single use facility. It's got a triple net lease, which basically means you rent it to them and they pay all the utilities, they pay all the property insurance, and you get one check every month for a specific term. So a simple deal that we put together, but I'm going to show you what happens when we started it several years ago. Actually, we didn't start it, we put it together, but it's not ours right now. But when it originated at old rates with a static lease term, meaning a lease term that was set for the life and it can't be changed except for some bumps every couple of years for inflation. Also, we figured a capitalization rate going out that we thought it would sell for based upon the market at that particular point in time. So all of these original inputs we set up when things were going great. We thought that the world would never end. We thought that the rates would never change, but guess what? They did. So let's hop in and I'm going to show you really quick what it looks like. I'm going to show you the cash on cash returns. I'm going to show you the internal rate of return going out and the ultimate valuation. And then I'm going to show you the interest rate we went in at. Just a few data points to hopefully show you a before and after and just why these vultures are waiting to swoop down on prey on these commercial real estate loans. So I don't want to get into the weeds too much on this. I just want to look at some fine detail, but I want you to walk away with an understanding of just how this plays out and why there's going to be this transitional wealth that's going to go from here to here in the next few years with those who have the ability to purchase. So real quick, we jump into Performa Plus. We see that originally we had a 4.5% interest rate. It was about a $7 million facility. We put about $1.7 million down in equity. That represented right at 20%. I'm sorry, it represented right at 20% down or 80% loan to value. So remember those, because back in the day, we could put 20% down. Back in the day, rates were at 4.5% and sometimes at 3.5% on some agency loans, like on apartments, Freddie and Fannie Mac, that were larger and longer term. But this one was 4.5%, 20% down. And I'll show you over here also, we estimated at the time when we did this modeling that we would have a going out internal rate of return or a valuation of the cap rate of about 6.5%. Now remember a concept, the lower the cap rate goes as far as market evaluation, the higher the value goes. So with all of those indicators, look down here, and I want to show you some other things that the bank requires you to meet as far as your covenant. Our debt service coverage ratio, which needs to be above 1.2 back in the day, met that in the years of stabilization here. So you can see we met the debt service coverage back then for our bank coverage. Now, debt service coverage ratio is your net operating income divided by your debt service, and that gives you a percentage. And usually it needs to be above 1 point something as far as the bank's concerned. Back in the day, you could get away with 1.2, or it would be 20% less than your total net operating income. I hope that makes sense. So your net operating income divided by your debt service, and when you do the math on that as a percentage, it's usually 20 or to 30% greater than your debt service at the end of the day. So banks look at that. So the main point is this qualified for it. Also, debt yield, usually you want to be at 10% or greater at stabilization. This met those criteria. Now, the cash on cash return, we usually require somewhere with a triple net lease in the 8 to 9%. And once again, at stabilization, we were at 8.45 in the third year. Everything looks hunky-dory. And then 2023 happens. Okay, so now let's take the same project, the same amounts, a little more principal reduction over 2 or 3 years, but I've got to refinance it now because my loan term has come due. So I go back to the bank to refinance, and the bank says, guess what? SOFR or prime rate is now not 4.5%, it's now 8 to 8.5%. We will refinance it, and our covenants have been tightened, but let's throw those into your software to see where you're going to be, Greg, and if this project is going to make, and ultimately whether you're going to have to turn the keys back to us or you're going to have to raise a lot more equity for us to refinance it. So as we hop back in, same project, same cost model, I'm going to show you here that I have increased my interest rate to 8%. I'm going to keep my loan to cost the same for this evaluation. And then as I go down here, you're going to see that my actual cash flow with just moving my interest rate now is actually a negative $42,000 a year. My cash on cash return now is a negative 2.39. My debt service coverage ratio is below 10%. It's never going to make a loan covenant, and my debt yield is at 9%, which means it's obviously below 10%. Look over here on the internal rate of return now. I've changed it. I've used column 1 here for my analysis. So let's use 8% now is my new cap rate, because I can't use 6.5 anymore, because the market says that now my capitalization rate should be almost 1.5 points higher than that in this marketplace. So they're only offering me 8% in the market mix right now. So I'm at 8% cap rate. And when I do that, my internal rate of return is almost 0. So what was previously a pretty good project, really good cash flow, cash on cash return, a decent exit on my internal rate of return going out upon sale, now I have a choice. I'm either going to have to come up with more funded reserves because I'm losing $42,000, but really what's going to happen is the bank's going to do this. They're going to say, we really love you, Greg, but you're going to have to come up with more equity and reduce that loan to cost to say 60%. So another 20% equity on this project would mean another $1.6 million that they're going to make me come up with just to loan me money on it. Therein lies, if you scale that much bigger, say at a multifamily apartment unit that's 30 million, they're having to come up with another 7 to 8 million, for example, and they're still just barely getting their debt service coverage to where it complies with the covenants. So they're going to make the decision. We don't want to go back to our investors and say, we want to keep this, but give us 8 million more. And the valuation has gone down because the cap rates have gone up. When you multiply that by the majority of the commercial real estate that's out there that's due right now, there's hardly any asset class that hasn't had a significant increase in cap rate, that hasn't had trouble controlling its operating expenses because of inflation. Everything has worked against them. So now they're going to push it back to the lender. The lender's going to say, I don't want it on my books. They've already marked it down. They're not in the business of holding real estate owned in their portfolio, so they're going to get rid of it as fast as they can. A new vulture is going to come along and say, I'll give you what the new valuation is. And then in the subsequent years, as there's no more product that's been brought online in the last 2 or 3 years, occupancy is going to start to increase. Demand is going to start to increase. Rents are going to start to increase. And this new wave of investors, these vultures, are going to take advantage of that, and they're going to grow wealthy. That's basically what's going to happen in this whole transition of wealth in commercial real estate. Hopefully, some of you are going to be ready to take advantage of that. We're keeping our powder dry for that as well. There's going to be a lot of us in the market that are waiting. Granted, there's going to be a lot of things to go through. That's why you need a software to quickly go through the evaluation to be first in with these deals. But there is going to be opportunity. You just need to be patient for it. So I hope that sets the table a little bit on why these things are happening, why it's too little, too late of a rate reduction, why the vultures are waiting, why you need to keep your powder dry. And for you in particular, this is a time to educate and then evaluate so you can ultimately execute. So be a vulture, not a roadkill. We'll see you soon.